Hello and welcome to Financial Education for the Nation. My name is Warren Shute and I'm here together with myself today. So I'm bringing today's recording not at all. I'm bringing you today's recording on my own. Gary, great listener of the show, messaged me and put something forward for our Hall of Fame, which is on our website. So if you want to go across to our website and go to Hall of Fame, you'll see starting to put some of the people on there who have fed back to us on how well they're doing. We put them on there. But one of the things Gary said is, hey, Warren, I'd like to know a little bit more about investing. So if you could maybe talk to me about investing, that'd be great, because we always want to hear from you. At the end of the day, the reason I do this is to help 1 million people create financial freedom. That's my outcome. And I can tell you what I think you need to know. So that's the 5 steps, going through the different 5 steps, knowing what your outcome is, getting financially well organized, making sure you secure your foundations, repay your unsecured debt, and then invest for the long term. But if there are elements of that that I'm not communicating clearly, or I'm quite clearly missing and you'd like to know more about, then let me know. And that's where things like our student guide has come from. People have said, yeah, I like the 5 steps, but what about kids going off to university or things like that, or finishing school? So you'll find the revised and updated student guide on our website. So if you are going off to university, you've got friends, family members going off to university, there's a great guide on there, tells you about the university fees, everything else, but also gives you a 36-month cash flow. So showing you where your money should go over the 36 months while you're at university. Assume it's a 3-year degree. If not, you can easily stretch on an extra 12 months on the end of that to make it a 4-year degree. And you just drop in there your income and your expenditure and things like that. So it's tailored for you. And again, please feel free to feedback some questions to me if it's not entirely clear. I want to make sure I get this to you. However, one of the things Gary mentioned was, hey, sure, I'd like to know a bit more investing. So I thought today, rather than have Paul ask me questions, which typically come from listeners or something that he thought about, what I wanted to do today is talk to you about investing. And I'd like to stimulate your response from these questions so you can feed back to me and ask me anything on the back end of this. So investing, right. Let's start from the beginning. We first have to secure our foundation. So we have to make sure we've got some savings, some emergency cash. So there's some money set aside in the bank account or in premium bonds for in case of emergencies. Once that has been ticked, and I'm not going to go into too much detail about that because I really want to make sure I stay on investing, your emergency cash is secured. You've then completed level 1, assuming your unsecured debt's repaid, of the House of Wealth. And the House of Wealth has got 4 levels, effectively. It's got the financial foundations, it's got financial security, which basically says between 3 and 6 months or 3 and 12 months of your expenditure as emergency cash, and your unsecured debt's repaid. Once you've done that, tick. We then move on to independence and freedom, which is the 2nd or the 3rd, if you're going up the ranks, and 4th level of the House of Wealth. This is where we invest, and we invest money into the stock markets and the bond markets. Now, there are 3 ways that I'm simplifying a lot here, I appreciate, but I want to make sure the information is clear, usable, and actionable. My outcome here isn't to become a lecturer and to educate, to be the best informed individual on investing, but the one who takes the most action and gets the best results. Okay, that's the purpose behind it. I'm sure there are 1,000,001 things you prefer to do in your life than invest money. It can be quite boring. But if you can take the salient information, act upon it, and get a good result, then quids in, you're a winner. So there are 3 ways in which you can invest. The first way is DIY, do it yourself. That means you open a stock brokerage account. You might do a bit of research on Google Finance or Yahoo Finance, or get one of your charting softwares that are available. You start thinking you're the next Warren Buffett, and you start looking at shares and buying individual shares. There are so many risks associated with that method that I don't want to labor on them, other than to say your time is better spent on your thing called your unique excellence, what you're really, really good at. And if you're not really, really good at investing, then don't do it. There could be a slice of that that is done for enjoyment purposes. So in other words, you like doing it. So for example, with my children, I have the bulk of their money in a portfolio, which I'm going to come on the 3rd point. but they do have some individual shares. And the reason I do that is it engages them in the process. I personally own a number of individual shares because I quite like the enjoyment process of it. But I'll assure you, it is the minority of my overall portfolio, less than 10%. Okay. My investment portfolio is managed in the third way. So that's step one, buying individual shares. And I don't think you should start with that, but I do appreciate there might be space for that once you've secured your main portfolio investments. The second method of investing is called active management. And this is where you will buy a fund, whether it's a pension fund, whether it's a unit trust or a stocks and shares ISA fund. And the fund manager is an active fund manager. So he or she buys and sells underlying shares or bonds, and their outcome is to beat the index, okay, beat the underlying market. I will say to you that virtually, I want to say all if I'm honest, but I'm sure I could be corrected somewhere along the line. So I'll say virtually all active fund managers fail to outperform the index in which they're measured against over a prolonged period of time, 5+ years, when you take everything into consideration, their fees, everything else. You will see some fund managers outperform the index periodically. And if you're working with a financial advisor that sells these active funds or recommends these active funds to you, they may show you periods of time where you think, actually, this has really outperformed the index. First thing, make sure the index that you're comparing it to is relevant. It would not be fair to compare a emerging markets active fund with a cash bank account, for an extreme example. It actually wouldn't be fair to compare an emerging markets active fund with a balanced account, a balanced index portfolio, or even a UK account. It should be benchmarked against possibly the MSCI Emerging Markets Index. MSCI stands for Morgan Stanley Capital Index. It's a company, and they create this index that you can give a benchmark of how the emerging markets have done. So make sure if you are investing in active funds, which I hope you wouldn't, but if you are, I respect that decision, that you are benchmarking your active fund performance against the appropriate index. And for the UK, you'd possibly choose the FTSE All Share. For the world markets, you would choose the MSCI World Index or the FTSE World Index, and the emerging markets, possibly the MSCI Emerging Markets Index. And there would be appropriate indices for bond funds as well, okay, bond funds being fixed income. But the message really here for step two about investing is, as much as you might think you want to beat the indices, as much as it sounds entrepreneurial, as much as it sounds exciting, and as much as you have this dream in your mind that you can, the probability is you can't, doing DIY, and actually the professionals managing the money can't after their fees over a prolonged period of time. They may over short periods of times, a few years or 5 years, but over your lifetime of experience, it's unlikely they're going to. So that brings us on to the third way in which you can manage money. And when I talk about managing money, this could be, again, for your ISA, stocks and shares ISA. It could be for your LISA, your lifetime ISA. It could be for your pension fund, or it could be just in an account. And this is by buying index funds. Now, an index fund and a tracker fund, for all intents and purposes, are the same thing. You could even throw in there a word called a passive fund. So there's three names representing pretty much the same type of fund: index, passive, or tracker. And this is where, rather than having an individual manage your money is basically managed either by a team or by a computer, and your basket of investments are spread over a wide range of the index. And a good example of this might be if you bought a FTSE 100 index tracker fund, you would own the 100 companies in the FTSE 100, and you typically own them in market capitalization order. In other words, size order. So you'll own more of the likes of Vodafone and Glaxo Wellcome than you will of the smaller companies in the FTSE 100. They're not all owned equally. Now, what's important with an index fund is not all index funds are the same. and this is a shame, and this is why it makes it so difficult for people like yourself to make informed decisions when investing. But this is why I do the Financial Education for the Nation podcast and YouTube channel, to help people make better decisions themselves. Some index funds just track the UK, some track international markets, some track emerging markets. And obviously from your perspective, it's like, well, where do I start? Which ones do I go to? Which is the most important one for me to do? When I present on this, I show a slide which I'm going to share with you now. So if you're listening to this, you won't be able to see it, but I'll talk you through it. But certainly if you're watching on YouTube, you will be able to see it. And you'll be able to see on the screen now, coming up, a slide that says investment success. So we're looking at a screen now that says investment success, and there's 4 jars on there with a nice little picture of showing the plant grow out of money. The first thing that's come up onto the screen now is a thing called term. This is the first thing that you need to consider when investing for the long term. Okay, so you need to say, how long is it until I need access to my capital? If you're going to say to me, well, actually, Warren, I want to put this money away, but I'd like access to it next year. I just want to try and make a bit of a return on the money. Or my son and daughter, this is my university money for my son and daughter. They're off to university in, say, 2 years' time. They're just finishing their A-levels. Sorry, just starting their A-levels, off 2 years' time. This isn't enough time for you to invest. When you invest your money, you put your money at risk in the markets. And because you put your money at risk in the markets, you are rewarded for putting that in the markets, and you're given over time a higher return. This is the difference between savings and investing. Savings, you're given a paltry return, 1.5%, but there's little or no risk to your money. I say little because obviously we've got inflation risk when inflation's higher than the rate of interest you're getting, and we've got default risk of the bank, but there's little risk to that money. When you invest in the stock market, you won't see your money stay the same. It will fluctuate. It's not maybe, it will fluctuate. And therefore, over time, you are rewarded for this. And that's why we say it's time in the market that's important, not timing the market. So if we invest in the markets, we want to be there for at least 5 years, but I always say preferably 7. And there's a switchover period there, a couple of years where you start possibly gradually making decisions because you don't want to do everything in one go. But if you need access to your money within 5 years, and you're going to crystallize it and bring it out of the markets, really 5 years is the limit, and you shouldn't be investing in the stock market. If you've got 7 years or more on your side, then great, this is the perfect time. So let's say, for example, you're like me, I'm 45 years old. If I'm targeting a retirement of, say, 67 or possibly 70, then I've got a good period of time on my side to allow the stock markets to reward me for that risk that I'm taking. So the second thing that you need to consider is the level of risk that you're willing to accept. Now, the 100% risk in the market would be that your portfolio could fall, for example, 50%. So what we experienced in 2000 when the dot-com bubble burst, as it were, if you all remember, cast your eyes back to that period where we thought computers would stop working, there'd be no cash machines dishing out money, and we wouldn't be able to buy anything in the stores. Does it sound familiar with Brexit? I'm not sure that there's a list of scaremongering tactics or not, but they were certainly using them then. We couldn't foresee what was likely to happen, but there was going to be this big Armageddon. And what we saw is the markets retrace, I think slightly less than 50%, but it would depend on which market you looked at, but typically about a 50% amount. So if you had £100,000 invested at the end of December 1999, over the next, say, 3 or 4 years, you saw that £100,000 reduced to £50,000. It retraced in value before it recovered again. And I'll show you some graphs in a second for those who are watching on YouTube. So if you're listening to this on podcast, you might want to go across to the YouTube channel. Warren Shute is the account, and then just watch it on there. Subscribe and you get updates on what's going on. We saw the same thing happen again. So after the 2000 retracement, the markets recovered, and then came the 2007 financial crisis, which basically lasted into 2008. And we again saw the markets retrace about 50%, as late 40s. And again, it will depend on the markets you look at. Unfortunately, Japan in the 90s retraced a lot more than that, but people don't tend to speak about that so much. But a 50% retracement wouldn't be unreasonable to expect. So if that worries you, then you need to dilute your risk. And the other thing is, if you're approaching a time when you're likely to take the money out of the market, well, you need to really dilute that risk. And this is why we say time in the market is your friend, because a 5 to 7 year period allows the market to go down this amount and then recover with some gains as well. Now, the amount of stock market risk you take, the amount of exposure to the stock market you allocate, will be different for every one of you. It will depend on how much risk you can tolerate and withstand within your financial other assets. And when I'm doing these presentations to companies, I often get everyone to stand up and say, okay, if we've got £100,000 invested, what would happen if it fell down to £90,000? How many of you would you begin to feel uncomfortable? If you begin to feel uncomfortable, sit down. So you can maybe play this game with me just by listening. Think of a notional £100,000, or if you're a particularly wealthy individual and that's not such an impressive amount of money, just add a couple of noughts on until it gets to an amount of money that's meaningful to you. If that £100,000 fell to £90,000, would you begin to feel uncomfortable, or would you expect that? Let me just digest that for a second. Now, if that amount of money fell to £80,000, how do you feel? If it fell to £70,000, are you still in the market, or are you beginning to question this nice young man who carries this podcast and does this YouTube? If it fell to £60,000, so it's gone from 100,000 down to 60,000, how are you feeling? What questions are raising your mind? And finally, if it fell to £50,000, how do you feel? Now, of course, this is a contrived scenario where I'm just asking you questions over the air, and you might be thinking, you might be euphoric and be quite confident in things going really, really well. The challenge you face is, at that moment, you are then bombarded with the media, and the media magnifies all of this by saying things are terrible and how wrong things are. I'm certainly not pro-Brexit or against Brexit. I'm fairly neutral, to be fair, but if you listen to the news, everything is how bad it will be after the event. And they may very well be, but what they're doing is giving you their opinion. And that's what I want to try and do, is cut through the noise and just look at the facts and look at the reality of things. With regards to the financial crisis and any stock market pullbacks, it's the news that influences you. You turn on the news and it's just bad news. You pick up the paper, it's bad news. You then start questioning yourself, and you start questioning your investment allocation. And it's only if you stay invested during the down times that you'll experience the upward trend of the market afterwards. So it's really important you get this asset allocation right. As a general rule of thumb, and this very much is a general rule of thumb, I wouldn't want anyone just to go away and implement this. As a general rule of thumb, we start with 100 and we minus our age, and we hold that in equities. So let me give you an example. If we got 100 and I'm 40 years old, I minus 40, I'm left with 60. I hold 60% of my portfolio in equities. Now, I'm 45, so that would say I hold about 55% of my portfolio in equities. I actually have quite a bit more than 55% of my portfolio in equities. Okay, so that's just a starting point to give you a bit of a dry run, a bit of a rule of thumb. So I won't want you to take that away, but certainly if you think, well, what it does do is if it says, well, actually, if I'm 80, Warren, you're saying 80 minus 100 minus 80, that's 20. You're still telling me to keep 20% of my money into equities. I am. And remember, it's because inflation is the only guaranteed thing that's going to erode at your portfolio along with charges. So two things, charges and inflation, guaranteed to erode your portfolio. You have to outperform charges and inflation. So we've got to be getting above inflation returns. And this is something that a lot of people don't necessarily appreciate, and certainly not spoken about a lot. So with the investment risk, take as much risk with the money as you feel comfortable taking, and also that you can withstand, that your portfolio can withstand. So if it's all the money you have in the world, you might be more cautious with it, as opposed to, I've got a defined benefit pension scheme kicking in, I've got all this other money somewhere else and I have lots of property. And the third thing to simplify investment success, we talk about wrapper, or the account that you hold this money into. So when we're investing money, where do we hold it? And the number one choice for most people listening to this will be pensions. And there's a number of reasons for that. Primarily, it's the tax deferment of the money. And I say that pensions are tax deferred vehicles, they're not tax free. And the reason I say that is when we put money into a pension, it either goes in before our money was taxed, or we receive some tax back on that money. It grows in a tax-free environment. And then when we withdraw it from the pension, we're paying a like-for-like lower rate of tax, okay, because we get 25% tax-free. So we're only paying tax on 75% of the money. And this obviously assumes that tax rates remain the same. If you're highly concerned about tax rates rising in the future, which wouldn't be unreasonable, then stocks and shares ISAs are a good place to look. But as a general rule of thumb, for virtually all of our clients, pensions are the first point of call. Another reason, it sits outside of your estate for inheritance tax, as long as you don't nominate your spouse to receive all the money. And on your death, they bring it in. So it can be very tax efficient from an inheritance tax perspective as well. I'm going to say all of you, actually. I was going to say virtually all of you, but I'm sure there isn't even an exception now. If you're employed, you'll have a workplace pension available to you. Generally speaking, these are the first place to look. But please check the charges. Make sure they are fairly charged, reasonably charged, and you're not stuck with high initial charges or tie-ins either. So if you wanted to move the money away from that provider at any time, you can do so without cost. Okay, so I started the recording of talking about the 3 ways to invest, and I said there was a DIY way where you bought and sold shares yourself, and said actually you got better things to do in your life than doing that. If you do it with a small percentage of your money and do it for enjoyment, 10% at most. The second way was to buy active funds. So within your pension, you choose a portfolio of active funds. The challenge you got with that is you have to be so competent in choosing that fund manager, and you have to be right on top of what they're doing, and you have to trust that that fund manager can outperform the market, bearing in mind that the majority don't over a period of time. And then we came to the third point, which is my preferred option of you choosing a index, passive, or tracker fund. Remember, they're all the same. And we choose a number of these spread around the world. So we don't just buy the UK, we buy around the world. And we're looking at term, so we want to be in the market for a long period of time. We're only going to put as much into those index funds as we feel we can tolerate. We realize that the amount that's in there could halve in value. So if we had all our money in there, all of our money could halve in value. If we had half of our money in there, well, that's just going to go down by about 25%. And then we're going to prioritize our pension wrapper over our ISA or our general account in that sort of order. Where the ISA does trump a pension is if you're funding for university, help your children through university, or maybe something like a wedding or a house purchase or something. You can access your ISA at any time, whereas you're unable to access your pension until 55 at the earliest. And if you're listening to this and you're thinking, well, actually, it's for me and this is for a house purchase, then seriously consider the lifetime ISA, the LISA, as that's a great opportunity for you to get a bonus on your money up to £4,000. So what I've just shown you there is the slide that I tend to use. And I'm just going to switch over and I'm going to show you the slide, which is going to explain to you a bit more about the investment that I choose. So let me just go back to this. Okay, so what you can see on the screen now is 2 charts going back to the earliest date that I have available. Now, it is not always the case that if you invest 100% in the stock market, you're going to do better. So on the screen, what you can see is a chart of the FTSE 100 index. And that is the largest 100 companies in the UK. And next to it, or being charted alongside it, is our own in-house 60% stock market, 40% fixed income portfolio. So if you remember rightly, I said if you can't accept a 50% reduction in your portfolio, then you dilute it with fixed income or fixed interest. And this is what we're showing is if you've only got 60% in the stock market and 40% in the fixed income. Now, the reason I show you this is the chart shows that the FTSE 100 is blue. And starting in February 1996 up until 2000, the FTSE 100 clearly outperforms. It's doing a lot more. I think from February 96 up to February 2000, there's like 100% return, whereas it looks as though the 60-40 portfolio that we operate is probably just over 50, maybe 60% return. Okay, and that would make sense, wouldn't it? Because if I've got 100% exposure to the stock market in the FTSE 100, and I've only got 60% exposure in the portfolio is going to give me about 60% of the return. It's about a 60% reduction. That's right, 40% reduction. But then comes the financial crisis in 2000. Comes the dot-com correction in 2000, where the portfolios pull back, and this is where the 60-40 portfolio performs better. And over time, what you've seen is that the 60-40 portfolio has actually outperformed, when we look until today's date, the FTSE 100 index. Now, there's two reasons for this, and this is important. The first reason is we're not taking all of the downside. So when the stock markets go down, because we're not fully exposed to the stock market, we're being cushioned. But more importantly, and more accurately, the portfolio that I'm showing on the screen is not a UK-based portfolio. It's an international portfolio. And that's very important. When we're investing, it's really important that we invest internationally and not just in the UK. There are a lot of advisors still that will have what you call a home bias. So they'll have about half of your portfolio in the UK, certainly the fixed income portion. And there's no real rationale behind that. The justification typically is that, well, you spend your money in pounds, so it makes sense to invest in pounds. That's not so such the case. I think it's really more important that you invest globally. So I'm just going to, I think I might pause that sharing there. So let me just share this with you. There we go. So we're sharing the screen again now. Sorry about that. I was sharing a different screen. So it's very important you invest globally. And the reason for that is the US is about 51, 52% of the world stock market. If you're not getting access to those companies, like Facebook, Microsoft, Apple, Amazon, okay, you're not getting exposure to their growth directly. The UK is only about 9% of the world stock market. So if we've got most of our money in the UK, we're limiting our exposure. And this is where a lot of retail investors will fall down when not working with a professional, because they might just choose funds they're more comfortable with. And what I'm saying is, first thing is to know, how long do you want to invest for? Well, it's more than 7 years warrants, I'm okay. How much risk can I tolerate? How much can it fall before I begin to feel uncomfortable or it potentially affects my lifestyle? Okay, so let's agree on what that might be. If it's 50%, then you can go pretty much full equity. If it's only 25%, then maybe we limit our equity exposure to about 50%. And then we want to invest using international or global index funds. We don't just want to invest into index funds in the UK. Let me show you another screen here. Ooh. Okay. Let me just go, I'm sorry about this. There we go. So what I've just shown on the screen now is if you were investing at the start of the financial crisis, 2007, and this is an important thing to consider, that you can see here on the 60% equity portfolio didn't fall as much and has recovered more quickly. Okay. And again, there's two reasons for that. The first reason is because we've got exposure to fixed income. That's why it did not fall so much. You were only 60% exposed to the market, not 100. And the second reason is we're internationally diversified. So I'm not saying on this webcast that it's most important for you to do 60-40. What I'm saying to you is get your downside right first. Understand how much your portfolio can fall before you begin to feel uncomfortable, and then invest internationally using index funds. And the last slide I show is from January 2000 through till 2010. And this is what a lot of investors call the lost decade. This is where they said there was no returns in stock during this decade. What's the point investing in the stock market? Is it really worth it? And the reason I finish on this slide really is because I think that this is likely to be a similar sort of story that will come out of any future downturn as well. And this was only the case if you invested in one market. So on the screen, what you can see here is you can see three lines. The first line, the red line, is our 60-40 portfolio again. And I've chosen that because it's middle of the road. It's the middle one. We start at 0, 20, 40, 60, which we're looking at, 80 and 100% stock market exposure. So it's the kind of middle of the one in the road. And then there's the two other lines. The blue line is the FTSE 100 and the green line is the MSCI World. And you can see that the MSCI World returned about 2% over that period of time. The FTSE 100 returned about just shy of 9%. But remember, this is over 10 years. So the FTSE, including dividends, returned about 9% over a 10-year period. So that's less than 1% a year. Okay. Whereas our 60-40 portfolio returned just shy of 50%, 48 point something percent. So although not exciting returns, significantly higher than those indices. And the reason for that is it's the asset allocation. Asset allocation, the mix between fixed income and equities is so important. So almost like as a final sort of selection really for you. I'm just bringing up Lexo, which is my online investment site. If you wanted any information on these portfolios, go to lexo.co.uk. You can see on here the returns and the performance of each of the portfolios. Lexo 10 has 10% in the stock market, and it goes up through the ranks 10, 20, 30, 40, 50, all the way up to Lexo 100 that has 100% stock market portfolio exposure. And you can see the performance of them, but you can also chart it and have a look at the chart. And even if you decide not to use us, this isn't a sales webinar. It's basically just a prompt to say to you, hey, look, have a look at what's available. Have a look at your current provider, make sure they are performing as you wished, and making sure that you've got exposure internationally. It's quite a busy line chart. There's obviously 10 lines on it, but you can see how each of them are performed over time. The higher allocation to equity you receive, the more downside risks you'll get, but hopefully over time, the more return you'll get. The key is to stay invested in the market during good times and bad. We do not know what's coming. We do not know what's coming in the future. It's very easy to guess and say, oh, we've had 10 plus years of of good investment returns. Sorry, it's bound to be a downturn. Brexit is going to be terrible for the economy and therefore the stock market. So it's going to be a downturn, this, that, and the other. What I would say to you is get your asset allocation right. Make sure your mix between fixed income and equities is suited to you. Make sure you're invested globally for both of these things, and sit tight. If you've got 7 or more years in the market where you need access to money, just sit tight and enjoy it. If you've got 5 years or less, you need to increase your allocation to fixed income, and you need to make sure you've got a strategy on what's going to happen in those 5 years. And if it's literally taking the money out, you really want to be de-risking, taking less and less exposure to the stock market and increasing your short to medium term fixed income so you reduce the volatility of your portfolio. That was a mammoth podcast. If you're still with me, congratulations. We went through so many things there, a lot more detail than I normally do. But hopefully that ticked the box for all our listeners who wanted to know a little bit more about investing. Any questions, please message me, let me know. I do listen to them, I do read them, and I do respond to them. So if there's anything you'd like to know, like me speak about, please let me know. That'd be great. Remember, I've got a workshop on September 21st, about a month's time. It's in London. If you'd like to come and join me, it's Get Things Done Day. So it's basically getting things done, our outcomes, our compelling visions, your bank account system, the wills, power of attorneys, everything else, getting things sorted, putting you on the right track. I can answer any questions you want on the day and we'll get it all ready and sorted for you. Please message me, go onto the website, get some more details. We're having a 100% money back guarantee, by the way, if you're not completely satisfied with the day. Also, if you want to be included on a Hall of Fame, if you've got a story of how well you've done, even if you don't feel it's that impressive, please share it. The reason I want to share these stories is because it motivates and inspires other people. And they look and think, oh, you're like me. And I want to get a good selection of single mums, single dads, married families, single guys, single girls, all different aspects of life who can look at it and say, that's like me. Oh, you've done that. I can now do this. Because when you're in the thick of it, when things are going against you, it's hard. It's hard. It's all easy to say, oh, it's fine, they can do it, I've done it, kind of thing. But it's not. You need reassurance. You need confirmation and certainty that you can get out the other side. And that's why I'm here, to try and help people from where they are today to where they want to be. And if I can share some of your stories, it can even be confidential. I can make up the name if you want, so it's not actually your name. I do like a photo, so if you want to give me some kind of photo of somebody who we can relate to, because people relate to it, and that's the whole key. The whole key is in warts and all, put it up there, you write it, you give the final sign off, and let's do this together. Let's do this together and create financial freedom. Remember, it's freedom from the worries of money. My name's Warren Shute. This has been Financial Education for the Nation. I've had a great time on my own with you. And until next week, take care.